Hi, I hope you're well. This is Justin Beaton from JBG Structured Investments. Firstly, I'd like to congratulate you for taking the step and investing in the Berkshire Hathaway investment 3 years ago. Time has certainly flown by, and over the 3 years, Warren Buffett has had a lot of money get to work for him. Over the last 3 years, which I'll go through in the presentation quite quickly, he's actually invested $100 billion into the markets. He's been presented with a lot of things that he calls elephants, which is elephant-sized acquisitions, to have his money spent very, very wisely. So today's presentation, I'd like to go through how the investment has performed, which is quite good. You'll be happy with the results, and also the options you have coming up as the capital protection is about to expire in a few weeks. It's actually the 5th or 6th of May. So depending on when you're listening to this, it is quite soon. So you do need to make an investment decision. So I applaud you for taking time out of your busy schedule for tuning in, but you do have to make an investment decision. By tuning in, hopefully that will be an informed one. So opportunity is missed by most because it's dressed in overalls and looks like hard work. When we go back 3 years ago, a lot of people had the opportunity to invest in our Berkshire Hathaway investment, but for some reason many people actually didn't. We were very successful in the capital raising. We raised almost $100 million across all Berkshire Hathaway series over a period of 12 months. And the returns have been phenomenal for all of them. But many people didn't actually invest. They came up with an excuse not to take advantage of the opportunity. I think that's the hardest part when it comes to investing, is to identify a great opportunity, and usually those opportunities are dressed in overalls and look like hard work. As you've seen, experienced over the last 3 years, hasn't involved much hard work for you. The hard work was required to take the investment step in the first place. Now you've got to make a decision, so now you've got to do some work, and that is to make an informed one as to whether or not you hold or walk away from the investment and take those profits. I'll go through your alternatives in a moment. Firstly, Secura Asset Management. Secura Asset Management looked at purchasing some of the assets of JB Global. We split up into two. The investment advisory business went to Secura Asset Management to be total self-managed super fund experts, where myself and a few other key people in JB Global stayed with JBG Structured Investments to concentrate on coming up with innovative investments that involve capital protection and also upside capital growth, like Berkshire Hathaway. This is general advice. What that means is that while we're a holder of an Australian Financial Services licence, we choose to only give education. We haven't considered your individual investment circumstances, and we don't. Our belief is you don't need a financial planner to reach your retirement goals or whatever investment goals you have. What you do need is an investment education. So we provide that education for nothing. If you haven't done so, please download a copy of my book, and that covers a lot of the investment philosophies and investment psychology I've spent a lot of time analysing over the past 15 years. The presentation is for general promotional purposes only. I encourage everyone to download a copy of the product disclosure statement, of which you should have been provided by your investment manager already. We'll go through a few sample strategies. I'm going to choose a case study, and the client is on a 38.5% tax bracket. Obviously, we're not accountants, and you should seek independent tax advice as to the tax consequences of the investment for your own circumstances. So let's look at Berkshire Hathaway. Berkshire Hathaway, the first investment philosophy that Warren Buffett has successfully been able to adopt over the last 60 years managing Berkshire Hathaway, is number one, never to lose money. That is number one rule. His second rule is to never forget rule number one. The way he's been able to successfully achieve that throughout history is that he's been able to negotiate very good terms. Terms like his Goldman Sachs purchase, where he invested $5 billion in what's called preference shares. It gave him the right to buy the stock, but not the obligation, at $115 a share. So if the share price fell below $115, he didn't have to convert to ordinary stock. So he got all the upside of the share price as they increased in value without the downside, and Goldman Sachs also paid him a 10% a year income. Out of that transaction, he's made about $3 billion to date. A great deal where he gets all the upside without the downside. His investment philosophy is very similar to ours in that he adopts capital protection. He doesn't believe in diversification. He's done that deal with Bank of America, again a $5 billion deal, paying 10% per annum as a preference share, and also the right to buy the stock at, $7.14 a share. It's currently trading around $12.20. So he's up around $3.5 billion on the Bank of America deal only a few years in. So there's some of the deals that he's done and been able to put in place over the last few years, but that's only a small amount in comparison to some of the elephant-sized acquisitions in addition to that he's been able to put in place. I'll go through in a moment. The other rule is look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. If the market is valued at a high level, Warren Buffett often gets crucified because he doesn't do much. But when Warren Buffett is extremely active is during times when he's able to buy great assets at a very cheap price. He's one of the cheapest men alive, which makes him an outstanding investment. He has a strict formula and sticks to that formula. That formula involves buying with a margin of safety. As you heard with the Goldman Sachs, Bank of America or GE deal, that involves some form of capital protection. So the key features of the investment was it was a high-growth investment that linked to Berkshire Hathaway, one of the greatest investments of all time. The annual increase in book value for Berkshire Hathaway has been just on 20% per annum for the last 60 years. It is the most successful investment company there has ever been. Warren Buffett is the most successful investor of the modern era. All that we're doing in our investment is grabbing on to his coattails very, very tightly and letting him drag in his direction. If you want to expose the Goldman Sachs, Bank of America deal, well, being an investor in the JB Global Investment, Berkshire Hathaway Investment, you actually enjoyed in the fruits of his labour. You borrowed 100%, the low interest rate was 4.95%, is very cheap. What we do here when we act as a bank, we gain access to wholesale lending, we pass them on to you as an investor. Where we make money is a performance fee, where it should be for asset managers. You borrow 100% for your self-managed super fund. What we've seen in the past is that most people invest in their own name. Now, though, 95% of our investors are using a self-managed super fund. You prepay 3 years of interest up front, quarterly liquidity, and a 3-year term. So those are the key features. So Warren Buffett, back in 2008, was able to buy a lot of investments. When the market fell and the majority of people were hitting the sell button in a frenzied panic, reading headlines that we can see on screen, hell of a day, hitting the wall, everyone was exiting the market. Warren Buffett was able to wave his magic wand. He invested $6 billion at the time. That was Australian dollars. Now with the currency increasing, it's $5 billion US into Goldman Sachs, and later Bank of America and General Electric followed that deal. So while everyone else in a frenzied panic, Warren Buffett is very greedy. He looks for outstanding opportunities like Goldman Sachs, and when they do come around, he has a big swing. Phenomenal. This is the performance of the investment over the last 3 years, thereabouts. As we can see, for the first 3 years, it didn't do much at all. First 2.5 years. Initially, in the first year, we had a bit of a performance. You paid out a very small coupon of about 0.5%. So it took 2.5 years of the market trading sideways for the market to gain confidence that what Warren Buffett had been doing the previous 5 years is going to come to turn out a result. It takes a lot of time for the money he got to work with those elephant-sized acquisitions to return into shareholder wealth. But the last 6 months has been phenomenal. Share price has gone from 70 to be where it's trading at today, $107. That's provided a huge return for us as investors. Provided we're patient and disciplined, we've made a lot of money. There were a few investors that decided to redeem prior to maturity. 12 months ago, we had an investor redeem, and of course it was down in value. He received $500 back. Had he kept the investment to maturity, being patient and disciplined like we ask every investor, that $500 would be worth close enough to 30 grand today. So congratulations on sticking with it and being a patient long-term investor. However, moving forward, you should be further a patient and disciplined investor. What we're doing is giving the option for investors to lock in those gains and extend it for 3 years. So you can continue to reap the rewards of what Warren Buffett has sowed over the last 5 years. Here's some of the deals in 2008. As I said, there was a Goldman Sachs deal, $5 billion he invested in that year alone. 2009, he invested $6 billion on property and equipment. Then he bought Burlington Northern Santa Fe, a railway line, for $26 billion. Not a small purchase. These are the elephants. Lubrizol invested $9.7 billion in the deal. He did the Bank of America deal, which is very similar to Goldman Sachs, where he was buying the preference stock. These are examples of where he's getting all the upside of the share price without the downside, plus a regular income. It's phenomenal. April 2011, he sold the Goldman preference stock. He made $2.25 billion profit. Just recently, he's decided to convert those free options he had. They were given to him for free with the preference stock. That is now worth almost $1.5 billion. So you add the two together, he's made close enough to $4 billion out of Goldman Sachs alone, and a very similar margin for Bank of America. Well, not just Warren Buffett, but you have. You're a shareholder of Berkshire Hathaway as well. 2011 spent $8.2 billion on property and equipment. IBM, November 2011, he bought a stake in IBM worth $10.9 billion. Just recently, he bought 50% of Heinz in a joint deal, which acquired all of Heinz for $28 billion. So as you can see, over the past 5 years, he's had a lot of money go to work, $100 billion. That's like investing all of BHP into different companies. When the market is at its weakest, though, that gives him a lot of opportunity to spend his money wisely. These companies all create income, all create cash flow for Berkshire Hathaway shareholders, which generates around $25 billion of the war chest each and every year of income coming into the business, of which Warren Buffett needs to allocate. So congratulations, you've enjoyed in a lot of the returns on the upside, but from now on, what you've got to decide as to whether or not you're going to enjoy in further growth of those companies that he's been able to buy over the last 60 years, or more importantly, the last 5 years. So the investment performance, the unit price is around $1.28 or $1.27.92 as of the 9th of April. It has had a few days where it's increased in value, so it should be close to 29%. We also add on the first coupon, which provides us a pretty good return. Now that's the rate of return. Let's analyze the return on the investment, because that's what's important, your cash-on-cash return. So if you look at the investor example of 100 grand, the initial unit price was $1. Let's say you invested 100 grand. You borrowed the full 100 grand through the compulsory limited recourse loan. You had to prepay the interest expense for the 3 years, the application fee, and the currency hedge. Thankfully, we had currency hedging on the investment, because the currency would have eroded a lot of our gains as the Australian dollar has appreciated against the US dollar. Because we had currency hedging, that hasn't had any impact on our result. Now let's assume you're an investor in the 38.5% tax bracket. If you're in a higher tax bracket, you get greater tax deductions. Now I'm not an accountant, but looking at the PDS, Bakers have provided an opinion as to how the interest should be deductible over the period. The after-tax cost is $12,980. So for the entire 3 years, the maximum amount you could have lost out of your back pocket after tax is $12,980. Yet you had 100 grand exposed to the investment, to Berkshire Hathaway, JBG Berkshire Hathaway investment. The current unit price is $1.27. The value of the investment is 127 grand. You had the first coupon of $600 the first year. Less the limited loan means your gain before tax is $27,920. A stellar result. You pay tax on some of that gains because you've held it for longer than 12 months. Let's assume as an investor in your own name, you've gained the 50% capital gains tax exemption. So total tax payable is $4,778, which gives you a total after-tax gain of $23,142. And this is the most important part. What it cost you out of your back pocket after tax is $12,980. What's going to put in your back pocket after the last 3 years is $23,142. This is assuming a 38.5% tax bracket. That is, it's provided a cash-on-cash return, or return on your investment, of 78.3%. Now 78.3% makes it one of the best investments in Australia over the last 3 years. So congratulations for having the ability to identify what was or has been a phenomenal investment. Now I don't know any of the investment that has provided a return greater than that over the last 3 years, except for our Berkshire Hathaway Series 5 investment. Now they're just able to buy in the same thing a few months later at a lower level. But for you, you've done a phenomenal result, which is good. You should be applauded. Give yourself a pat in the back. But where to from here? If you've read the JB Way, if you haven't, I encourage you to do so. What we adopt is active management. Just because the capital protection expires doesn't mean we walk away from the investment. Take our money, spend it on a car, waste it, which isn't going to be worth anything in 3 years' time. So you do have the option of walking away, taking the capital. The other option, what we're going to adopt, is to lock in the gains and roll on. So we extend it for another 3-year period. We lock in the gains, so if it does fall from $1.25 back down to $1, you're still selling it at $1.25. But we extend it for 3 years and lock in the gains and include or cover the cost for the next 3 years, because obviously you're going to have interest expense again, the currency hedging fee. You cover those costs by utilizing the gains. So you can get the next 3 years for nothing. It costs you nothing out of your back pocket. So for me, if it's costing me nothing out of the back pocket, it's provided me a 78% return on investment for the first 3 years. The last thing I want to do is walk away. I want to go again. So the key features of the new investment is exactly the same as your first investment, but there is a few minor adjustments. Royal Bank of Scotland will not be the issuer and it will not be the lender. JBG Structured Investments will be the issuer, we'll be issuing it ourselves, and we'll be using an investment grade bank similar to Royal Bank of Scotland to provide the lending and the hedge. It's an extension for another 3 years. Again, you have to borrow 100% of the investment amount. You can do it in a self-managed super fund. So if you had a self-managed super fund or set up one recently, it's something to consider to gain exposure to Berkshire Hathaway using your super money. And again, you can look at borrowing inside of your super because the loans are self-managed super fund friendly. The interest rate's 4.95% again for the next 3 years, so there's no change. The currency management fee is increased to 1% from 0.5%. That's for the entire 3-year period. You do have the application fee to also pay again because it's a new investment for the next 3 years. What we have changed a little bit, look, I don't think the Australian dollar will stay above parity against the US for the next 3 years. So what we're doing is changing the gains to be paid out in US dollars. So if the currency goes from $1 back to 80 cents, which I think may occur, the 20% fall will mean our gains will increase by 20%. So let's assume for the next 3 years that the investment goes up 30% again. If the currency falls like we expect, you'll actually be making 36%. And conversely, we do take a bit of risk. If the currency does continue to rally and goes up 20%, the return won't be 30 but be 24, just as an example so you understand the different changes. We're also increasing the coupon. Rather than be a maximum of 8.1%, the coupon each year can be up to 10.8% in the first and second year. Why we're doing that is to act as a harvesting the growth along the way and provide a regular income to you. But it is contingent on performance. The first 3 years you got a small coupon in the first year because there was no performance or very small performance. The second year was still below the entry level, so you didn't get paid any income. We need Berkshire Hathaway's investment to increase in value for us to provide a coupon. As I said, you're going to gain exposure to the AUD-US dollar exchange rate. So these are the key risks. Again, there's no guarantee that units will go up to generate a return greater than the interest expense, even though the interest expense is very low, the currency hedging fee and the application fee. If it doesn't go up, obviously you've got to fund the loan, so there'll be no refund of that money over the 3-year period. Capital protection only applies at maturity, so if you do choose to walk away, choosing the liquidity, which is every quarter again, then there is no refund of those interest expense. So it's more of a profit-taking mechanism than an ability to walk away. Your returns are obviously affected by the performance of the underlying investment. If the investment doesn't go up from here on, you're not going to make any more money. Counterparty credit risk, the coupon and the final value is dependent on the issuer and also the hedge counterparty being the investment bank meeting their obligations. So let's look at the example. Let's say the initial investor had 100 grand. Now this investor wants to roll over all the gains. They've had huge returns. It's been phenomenal. They're happy with 78%. What they want to do is extend it for another 3 years, not cost them any money out of their back pocket. They don't need any capital. They realize if they take the capital, then they're taking money away from the world's greatest investor, and they can't invest it any better than what Warren Buffett can. They understand that. If they weren't investing in it, buying a car, they realize in 3 years' time that's not going to be worth too much either. So they want to keep the money involved in the market because the more money you have involved in the market, the greater the return. They also, like all Berkshire Hathaway investors, wish they invested more initially. So by rolling all of the gains, it enables them to increase the investment and the loan amount. So the initial investment was 100 grand. Current unit price is 127, so the gain before tax is 27,920. What they're going to be doing is rolling all over those gains over to gain as much exposure to Berkshire Hathaway as possible. We'll pay after the performance fee, so the total gain, 25,000. That's how we make money, which is the way it should be, is when asset managers perform. We're performed, so I'm happy to take a fee, and I hope you're happy to pay me. It's a win-win situation for both of us. So now they're going to roll on. They're going to extend it for another 3 years, which is the option that most investors are taking. They want to roll over the whole gain. They're astute investors like you, and they've decided to increase their investment amount because like all other Berkshire Hathaway investors, they wish they had more. The new unit price is $1.25. So if they use the entire $25,128, the total gain they're getting in their back pocket, use that to prepay interest, they're actually going to have $123,479 as a new investment amount. So they increased their investment by 23%. They've got 23.5% more money invested, and it hasn't cost you a cent out of your back pocket. And that continues to gain the upside pleasure of being an investor for Berkshire Hathaway for the next 3 years. The other option is to walk away. If you walk away, there's only been one regret for those people that sold Berkshire Hathaway, and that is they wish they didn't do so. Berkshire Hathaway at the moment is trading at $160,000 a share. 160,000. People thought $100 was expensive. People thought $1,000 was expensive. At 100 grand, they thought, how could a share be worth 100 grand just for one of them? Well, it's $160,000 a share now. I do not believe it's going to stop anytime soon. Another option is rather than rolling over all of the gains, they want to take some profits and maintain the initial investment amount. This is what some people are doing. So 100 grand, the gain is the same. Rather than increasing the amount, they want to just maintain the 100 grand exposure. So to maintain 100 grand, you only need 20,350, which means if you want to maintain your exposure, you're actually going to get paid. You're going to get paid $4,778 into your back pocket. Now, all these results in the unit price is dictated by the final value, which is on the 6th of May. Obviously, between now and then, the market may move, and that will influence the unit price to the positive or the negative. So we're confident it's going to be close to this, but it either could be a little bit better or a little bit less, depending on that performance. But based on the unit price as of the 9th of April, you'd be getting almost 5 grand in your back pocket, yet you still hold the investment and exposure to Warren Buffett, the world's greatest investor, for the next 3 years for free. So you paid 5 grand. Thanks very much. I'll take that money, take my missus on a great holiday, and you've got the upside profit potential to Buffett for the next 3 years. No cost out of your back pocket, so that's pretty good. Some people are utilising increasing their units. They want to gain greater exposure. They've got a bit of capital they're looking at investing, so they want to back the best investors that they've had. It's been a great one, so they're investing more. Some wish they also invested in their super. Many people are choosing to roll over their entire gain and also invest using their self-managed super fund. If you look at Buffett, there's a few articles that have been written recently. This is one in the Sydney Morning Herald that came out on March 13th. There are 2 elements to any successful investment: finding a great business, then paying a reasonable price based on the assessment of that business's future. As far as quality businesses, outstanding track record go, they don't come much bigger and better than a company run by the world's 4th richest man. I think he's the 2nd now, Warren Buffett, with the Berkshire Hathaway recent share price. So it's not just me saying that it's a great investment, but it's also interesting that other people in the marketplace that are astute investors are also stating that it is. If you go on to the article, at current prices, there are plenty of reasons to believe Berkshire Hathaway is one of the easiest investment decisions you can make. Again, these aren't my comments, these are of the journalists. I agree with them all, that's why I'm reading them. As such, Berkshire Hathaway is a group of great businesses whose success depends little on the person at the top. Regardless of who's running Berkshire, those subsidiaries will go on, increasing sales profits as a result and shareholders' wealth. The growing stream of cash from both sources give companies a nice problem. How to invest all of the money that is flowing back to its headquarters? There's $25 billion a year coming in new business, in income from those businesses as a whole. Berkshire is a strong business with loads of cash on its balance sheet, a very large, stable and successful, profitable group of companies, a listed portfolio of some of the world's best businesses, and 2 proven investment managers, plus Buffett himself. You expect to pay a significant premium for that combination, but the kicker is that Berkshire Hathaway is available for only slightly more than 1.2 times its book value. That's a reasonable price for an average business, an attractive one for a good business. In my book, that makes Berkshire, which is an outstanding business by any measure, available at a very attractive valuation indeed. That's at 160 grand. Now, these aren't my comments, this is from someone else, a journalist. Buffett himself. So here's Buffett stating what he's willing to buy the stock at. This is he's instituted a share buyback, so he's willing to buy back Berkshire Hathaway stock at or below 1.2 times book value, which is pretty much where it's trading at now. So that creates a fair backstop to the share price when Buffett himself, who can buy shares in any company, is buying it in Berkshire Hathaway. The reason that he's doing that is he believes Berkshire Hathaway is the most undervalued company in the market. It's worth noting that as Buffett only buys when he's given a margin of safety, he likely believes that this price is somewhat undervalues the company. Again, back to the journalist. Long-term investors looking for a collection of strong, solid businesses with the competitive advantages and good growth prospect, a Fort Knox balance sheet, and shareholder-friendly management available at an attractive price need look no further than Berkshire Hathaway. That's phenomenal. Here's another article that came out recently talking about how Buffett nabbed the Goldman Stakes, and for his free warrants that he paid nothing for is worth around $1 billion. And GE strategy was the same sort of thing. So he's had a lot of money to go to work for him. But what I want to do now is go out through history. If you look at his annual shareholders letters to annual shareholder letter, which you can get at the Berkshire Hathaway website. It's berkshirehathaway.com. Great website. It's written by Warren Buffett and looks exactly the way you would expect it to. But every year he measures himself against the market. So he measures himself as a benchmark to the book value of Berkshire Hathaway. Now I want to go through these results because it's interesting. Every time the market has a weakness, since 1965, since Buffett has been running Berkshire Hathaway, he's been presented with a lot of opportunities. And those opportunities he's had a lot of money go to work for him. So rather than looking at what happened immediately after that correction, what I want to do is move forward 5 years. Because the last time the market had a correction, if we look down here, bear with me one sec, if we look down here, was 2008. And 5 years on from 2008 is where we now face ourselves with an investment decision. We now face ourselves with an investment decision as to what the next 3 years looks like. So every time throughout history, let's go back to 1965 and look at when there's been a market correction where the S&P has gone down in value. Look at the performance of the increase in book value of Berkshire Hathaway 5 years after that correction and then 3 years forward. So the first time it was 1996. If we go forward 5 years and analyse the performance 3 years following that, which is where we are today, which hopefully will give us an indication of what's going to happen for the next 3 years, not the past performance indicator of future performance, but if we look at the past, we can hopefully have a fair amount of certainty as to what's going to happen in the future. So the 3-year performance 5 years in, 5 years after that correction, Berkshire Hathaway went up 31.9%. The next correction was in 1969. 3 years on, the market, which is 75, 76, 77, Berkshire Hathaway's book value increased by 83.1%. So what you see in history is that he puts a lot of money to work, and it takes a few years for that to come to create shareholder wealth. 2.5 years into our investment, there was no value. The share price or unit price hadn't increased. But the last 6 months, we've started to see the performance flow on to our investors, which is great news for each and every one of us. Next one was 74, 5 years on, 79, 80, 81. The book value increased by 86.4%. Next correction, 77, 3 years on, was 83, 84, 85, performance 94.1%. Next correction, 81, 5 years forward, fast forward 5 years, the performance 3 years after that, 87, 88, and 89, including the 87 crash. Berkshire Hathaway's book value increased 84%. Next correction, 1990. 5 years on, performance 114.2%, phenomenal increase in book value. Next one was 2000, 5 years on, the performance 3 years later, 19.8%. So where we are today, 2008, you go forward 5 years, well that's where we are today. The performance for the next 3 years, yes I don't have a crystal ball, but what I can say with a lot of certainty is that like all the corrections in the past, Warren Buffett has put a lot of money to work. As I said before, he's invested over $100 billion over the last 5 years. I hope you enjoy in some of the profits that he's able to generate from those purchases. When you look at them, for me, it is genius. He negotiates very attractive terms, generally with no downside, huge amounts of income along the way, and capital growth upside, like Goldman Sachs and Bank of America. He's a phenomenal investor. But if throughout history, if you look at the average of all those times that are very similar to what we face at the moment, the performance 3 years on is an average return, book value return of 73.35%. Now, while past performance is no indicator of future performance, we look at history, there is a lot of commonalities between the two. So that's hopefully something to go by for the next 3 years. Now, if it's only half that, if it's 50% return that he's achieved over the last 60 years, we're still going to be doubling our money when we look at the return of investment for the JBG Berkshire Hathaway investment. So again, to highlight, you have an investment decision to make. I hope I've been able to give you a bit of information to make an informed one. The next step from here is to organise a meeting with your investment manager. I know we've been running investment seminars and investor updates across the country, so no doubt you had something, some other arrangement where you couldn't attend. Hopefully this small podcast or webinar, whatever you call it, gives you a bit of information and a summary as to what was covered in those workshops. But by all means, for me, I want you to remain a patient, disciplined, long-term investor. Just because the capital protection expires in a few weeks on the 5th of or 6th of May doesn't mean you walk away from the investment. As I said, Any investor that has redeemed or exited Berkshire Hathaway has soon wished they didn't. They would have only made a lot more money had they stayed a patient and disciplined investor and backed Warren Buffett. Last 60 years has been the most successful investor of all time. If you invested 10 grand back in 1965, it'd be worth over $300 million today. So don't make the mistake and just walk away without considering your options. Consider all alternatives, and for many people that is to increase their investment amount. For now, thanks very much for tuning in. Organise a meeting, contact your investment manager ASAP so he can go through specifically for your investment amount, your options. So thanks for tuning in. Happy investing, and I look forward to see you around the country at our regular investor updates. Bye for now.